Hi guys, today I'll be going through with you the complete candlestick patterns trading course. Okay, it's quite in depth and a lot of information. So I hope you've got your coffee ready, you've got your notepad and your pen ready, and you're ready to take notes. Okay, because what I'm about to share with you is key to being a successful trader. Okay, I know you might be itching to get straight to indicators, etc., but these are your foundations. Okay, so like the house example, all right, if you build weak foundations in the house, or you build a house out of straw, then the house will get blown away the minute a wolf comes and huffs and puffs. Okay, but if you build a foundation on solid brick, strong bricks, etc., that house will last you a long time. It will be structurally sound. The same goes for trading. Okay, so if you build your foundation knowledge of candlestick patterns and price action, this information will be key to your success in the long run, and everything else will make sense and fall into place. So everything else to do with trading being successful, like indicators, money management, everything, stop losses, profit targets, etc., all that would make sense if you build a strong foundation. The topics in this trading course, first of all, what is a candlestick? Okay. Next one, the different candlestick patterns, the most common. Okay. So, although they're very common, but a lot of investors and traders misuse these patterns, misread these patterns. There's a lot of misconception with these patterns on how they should be used. Okay, so understanding what the pattern is, how the pattern is derived, and how you can use it in a strategy is key. So the next, combining candlestick patterns for confirmation. Okay, although candlestick patterns can be used in isolation, this is investment. Chances are you have hard-earned money at stake. Okay, so you want to be at least 70-80% certain before you put your money behind any decisions you make. With confirmations, I mean one candlestick pattern confirming another, usually around a certain price. Like for instance, Apple, they're trading at, let's just say for argument's sake, they're trading at $20 a share, okay? If you see multiple candlestick patterns around $20, then there's your confirmation. You're almost certain that the market is going to behave the way you're predicting it. So the next one, combining candlestick patterns with indicators, confirmation. Okay, so these are using candlestick patterns that happen or arise around an indicator. Let's say if you're using a moving average, or you're using a Bollinger Band, or you're using RSI, okay, and a candlestick pattern occurs at one of these. For instance, if you're using the RSI, if you get a candlestick pattern occurring when the RSI value is 70 or above, then those will be your confirmation, okay? And lastly, I'll go through some live examples. These are high success rate examples with yourselves. So what is a candlestick? These were originated in Japan, hence the full name is Japanese candlesticks. Okay, so the reason they were created was to illustrate the sentiment of market in graphical form. This is effectively a graphical illustration of what's going on, how many buyers there are related to sellers and vice versa, and the ratio and everything, so you can know the momentum of the buyers, how much demand there is related to the supply, and vice versa. These candlestick patterns are available on pretty much every trading platform, whether independent or as part of a broker. A candlestick involves 4 points. Okay, so you have your open, you have your low, you have your high, and you have your close. So for a bullish candlestick, the close is always above the open. This example, the market opened, the bears tried to take control, brought it down to the candle's low, okay? The bulls took control, took it all the way up to high, which saw some rejection and resistance, by the bears, which eventually closed this candle at this point. Okay, and vice versa with a bearish candlestick, you also get the 4 points. You get open, high, low, and close. The market opened, the bulls tried to take the price high, which created this high. Okay, the bears took control, brought it all the way down to the low. The price saw some rejection by the bulls, which eventually closed the price at this close. Okay, and one of the things about candlesticks, just like candles, they have wicks, okay, or shadows. So these shadows, as you can see, they're wherever the price went to, but didn't form a real body. Okay, so the green here in the bullish candle is a real body, and the wicks on either side are your shadows. So these indicate basically the rejection of price at these areas. Okay? Okay, so for here, between the high and the close is effectively your bearish rejection of the price. And between the low and the open is effectively your demand, your bullish momentum, and bullish power within that session. Okay, so every candlestick is called a session. Okay, so if you're plotting a chart within a 1 minute or 1 hour, so let's say you're 1 minute, every time a minute passes, a candlestick will form, meaning that that session has traded. And for the hourly, the same applies, and for the daily, the same applies. So to summarize, a candlestick is made up of 4 points: open, high, low, close. So the next point, the different candlestick patterns, the most common. I cannot stress this enough. Okay, these are crucial to know if you want to build that solid foundation in your trading knowledge. So the first candlestick pattern are your engulfing patterns. So you have your bullish engulfing pattern. There's 4 points. There's open, high, low, and close. There has to be a preceding trend. So for the bullish engulfing, there has to be a downtrend, and it's a 2-session pattern. All right. So as you can see, the bulls took full control and effectively engulfed this bearish candle, which shows that the sentiment is actually on the buy side. All right. The emotion of the market is on the buy side. All right. So one of the reasons, in fact, the main reason I like candlestick patterns, they're very good with indicating the emotions of the market. And that is why price action is and will always be the fundamentals to trading. If you're new to trading, my advice is always start learning about price action before you go into looking at indicators, etc. With the bearish engulfing, there's an uptrend. All right, there has to be a trend. Preceding trend is up. The bulls took the price all the way up to this wick or the high, so the bears brought the price all the way down. All right, engulfing the bullish candle, which indicates that there's likely going to be a reversal in trend. And the main thing about these patterns, why they're so effective, is that they indicate when a trend is likely to either stop, reverse, continue, or it's going to be a sideways pattern. All right? Sideways pattern is basically the price rises to a point, decreases to a point, rises to the same point, just basically bounces between the points. The points being resistance and support. All right, so the next patterns are your tweezers. Okay, so you've got your bearish tweezer and you've got your bullish tweezer. So preceding trend coming down, the bears tried to bring the price all the way down to this low. There's been a rejection by the bulls to make the price close at this point. Next session, the bears brought the price down to the exact same point. All right, but there's been a huge rejection and the bulls took control of that session. All right, so this is the price here, assuming it's, let's say, $20. This is a point to watch out for. So that was a tweezer tops, which is effectively a bullish pattern. All right, so with your tweezer bottoms, it's a bearish pattern. All right, so the bulls tried to bring the price all the way up to this point. There's been a rejection by the bears, brought the price and closed around this point. All right. Again, the next session, the bulls tried to bring the price all the way up to the same point. All right. There's been a rejection by the bears to bring the price and closing the price at this, or closing the session at this price. All right. So you can be confident that this is a price to watch out for. There's usually a lot of supply around this area which will reject the price. Candlestick patterns effectively form support and resistance. The next pattern are your dojis. All right. So you've got the flatline doji, dragonfly doji, gravestone doji, and lastly is effectively just a doji. So there's a lot of indecision in the market with the doji. So your regular doji, the prices come up, prices decreased, and the session closed where it opened. All right, dragonfly doji, the session opens, the bears brought the price down, there's been a rejection by the bulls, brought the price up, and there's been a close where the session opened. And vice versa with the gravestone doji, the session opened, bulls brought the price up to the high, bears rejected, brought the price back down, and the session closed where it opened. A variation to the doji is your long-legged doji, which effectively is longer wicks, which shows there's been a lot more momentum and buying or selling pressure within that session. All right, so there's been a lot of buy pressure in this session to raise the price quite high. There's been a lot of selling pressure to decrease the price down to this low, and there's been a lot of rejection to close the session where it opened. The next common and effective patterns are your evening star and your morning star. So your morning star, there's been a downtrend, the bearish candle, the next candle is either a doji, it's most likely a doji, all right, or it could be a bullish bodied candle, all right, but it has to be small. And the third session is usually a big bullish candle, or a bullish candle that's the same size as the bearish candle, which means the bulls have taken control and the price is likely to rise, all right, and vice versa for evening star. There's been an uptrend, last bullish candle, a bearish candle or a doji, and then a bearish candle that's the same size as the bullish candle. This shows that the trend has been rising. It's lost steam potentially at this bearish candle, and the bears have taken control of the market, which means that the price is likely to fall. So the next patterns are your hammer and your shooting star. There's been a downtrend. The bears have tried to take the price down. All right, the bulls have rejected and brought the price up, and vice versa for the shooting star. There's been an uptrend. All right, the bulls have tried to take the price up to this high. There's been a huge rejection of the price, and there's been a close. So your inverted hammer, there's a downtrend, okay, and the bulls have tried to bring the price up, but there's been a rejection. Now, why this is significant is there's been a downtrend, which means there's been a lot of selling pressure, and this is a good indication that one, the downtrend is ending, all right, and two, the bulls potentially have momentum around this price to bring the price up, effectively rejecting the trend, preventing the bears from decreasing the price further. The next pattern is a spinning top. So your spinning tops, effectively the dojis with real bodies, okay? So there's your bullish spinning top. So the price has been falling, all right? And the bears tried to take the price down. There's been a rejection by the bulls, took the price all the way up. There's been a rejection by the bears, brought the price down. The close is always higher than the open. Vice versa for a bearish spinning top, there's been an uptrend. Bulls tried to take the price high, rejection. Bears tried to take the price down, rejection, and there's been a close below the open. So the next pattern is your 3 black crows and your 3 white soldiers. So for the 3 white soldiers, there's been a preceding downtrend, all right? So the trend has been falling, all right? The bears tried to take the price down to this low. There's been a rejection. The bulls took the price all the way up to this high. There's been a tiny or small rejection, and there's been a close, all right? So that's a bullish body, real body, all right? The next session, the bears tried to bring the price down, okay? There's been a rejection again, and there's been a close, usually higher, okay, and there's been a close, the price is always going to be higher than the previous candle or the previous session price. So for the third session, again, the bears tried to bring the price down. There's been a rejection by the bulls, brought the price up, and then there's been a close. So one of the things to look out for, or how you can distinguish between the white soldiers or the black crows and basically not one of these patterns, is they've always got a wick to indicate that. So for instance, the bears try to keep the downtrend going, all right, with these wicks, but they fail miserably on all three sessions. And vice versa for the black crows, there's been an uptrend, all right. The bulls try to take control or keep control, all right, which is indicated by these wicks. But every session, the bears have brought the price down, all right, even further. So the next pattern is your 3 inside up and 3 inside down. So the way I see these candlestick patterns is that it's a variation of an engulfing pattern. So those are all the candlestick patterns, the most common ones in isolation, all right. So to summarize, to increase the effectiveness of these candlesticks, or at least help you filter out all the false signals, then there must be a preceding trend into these candlesticks. All right, guys, so we're on TradingView. All right, so we're on a chart of Euro US dollar as it's defaulted to this. Okay, so as it's defaulted to a Forex chart, we'll start with the Forex chart. Okay, let's look for patterns in the market. Okay, so the first one that jumps straight at me. All right, I'll give you guys a second to see if you see what I see. So the first one that jumps out at me is a bearish engulfing. And it's a sweet bearish engulfing, all right? So first of all, we'll look at these patterns in isolation, and then I'll look at these patterns as a combination, like if you're combining these patterns, and illustrate the effectiveness of combining these patterns together. And also I'll look at combining these patterns with an indicator, all right? So my indicator of choice would be, I'll just use moving average, okay? The first pattern I see is a bearish engulfing. All right, so let's just draw a line. So the points that effectively make these patterns, there has to be a preceding trend. All right, so this is a bullish trend. As you can see, the bulls started, took control of the market and rose the price all the way up to what we're seeing here at 114. And then we saw the bearish engulfing pattern happen. So the bearish engulfing pattern, you've got on this session, you've got the bullish candle, all right? And then next session is a bearish candle, which totally engulfs the bullish candle. The price pretty much falls from there. If you see these patterns forming, it's usually an indication or an early indication to the preceding trend ending and the next trend forming. So getting in on these patterns, you often, more often than not, you get in early on a good trend. So as you can see here at the bottom at this price, I'll just mark it as my support. All right, so I'll give you guys a minute to think about what pattern has formed here, if any pattern has formed at this line, at this point. So the pattern that's formed is actually your tweezer tops. All right, so as you can see, the bears took control on this session, or were in control of this session, tried to bring the price down. The bulls rejected, all right, and then it closed bullish. The next session, the bears tried to bring the price down, all right, to the exact same spot. The bulls rejected that price, and there was a bullish close. And as you can see, from then on, the bullish trend commenced and continued, raising the price up to this point. Although that's the tweezer tops, in a way, I can also see the 3 white soldiers. All right, so the price has been falling. All right, there's a bullish close. The next session, the price has tried to come down. There's been a bullish close higher than the previous close. And then the third session, the bears tried to bring the price down a little bit. I don't know if you can see it. Let me just expand this. All right, the price, very subtly, they tried to bring the price down. All right, the bulls rejected. And again, there's been a close higher than the previous close. The reason I'm showing this is that with trading, you need to be dynamic. All right, so let's go and have a look at a stock market, okay? So let's just look at a favorite of everyone's, all right? Amazon. So looking at Amazon, as you can see, is the same. The only difference between the Forex and the stock market is you get gaps with the stock market. Now, the reason for this is the Forex market is open 24 hours a day, 5 days a week. All right. So it's usually smooth. The open and closes are always smooth, apart from when it opens at the start of the trading week on a Sunday. So with stocks, there's always a gap because there's 8 hours of trading a day, and then the market closes for the next day. All right. And within that period where the market is closed, there might be news that's happening, micro or macro news that's happening, all right, that would cause the markets to gap up, gap down. As you can see, there's gaps here, all right. So these patterns are the same, all right. They're just usually more of a variation of the patterns. You just need to be better at spotting these patterns with stocks. So I advise you start off in Forex with these patterns until you become very confident with them. All right, so let's look at the pattern here. All right, so as you can see here, this point, I would say that that's a three white soldiers. All right, because the trend, preceding trend has been down. All right, brought it all the way down here. There's this gap down, which is seen as bearish as well. All right, so the bulls took control in this session. All right, held control of the session, the next session, held control of the next session and the third session. For the subject of this tutorial, I'll use Forex charts, all right? Just so there's no gaps and it's easier for you guys to see, especially if you're new, all right? So now let's look at price action confirming another price action, all right? So here, this is a good point, all right? At this area or this resistance, it's a good point to start off with, okay? So as you can see, the price started rising around here, brought it all the way up to this price, okay? And then the pattern that you see, the first pattern is a bearish engulfing, all right? Now, this is the price to watch out for, all right? To see what happens if the price gets away from this area and tests this area. As you can see, every time the price reaches this area or touches this area, it's called a test. And then the next time it touches it, it's called the retest. And then after that, it's retest, retest, retest until it either breaks it or breaks down. All right, that's for a bullish trend. Okay, for a bearish trend, it tests and retests until it breaks down or it doesn't. As you can see with this bearish engulfing, the bears try to continue or start their own trend, but the bull still had some steam. All right, and they brought the price back up. They tested. All right, this shows to be an actual resistance point because the bears took back control at this point, showing that there's supply in this area. All right, again, the bulls continued. The bulls were being stubborn. They're like, nah, we need to continue this. We need to keep this price going, But the bears are like, nah, not today, not today. And another bearish engulfing pattern happened. As you can see, there's a trend forming here. There's a trend forming here. A small trend. These are all small trends. But interestingly, on this bullish candle, the bulls broke the price. All right. Now, a lot of investors would have been like, oh, this is the time to buy. This is a breakout strategy. Great, great, great. All right. But the next session was bearish. All right. So this is effectively what's called a false break. And a lot of institutions, a lot of smart money, basically, set these traps up for investors, novice traders, and emotional traders. They set these traps up for them. And more often than not, they fail. This is why, just a side note, this is why in Forex they say 75 or 80% of people who trade Forex fail, is because they fall for all these traps. All right. I always wait for a confirmation or even two confirmations. What you see is effectively a sideways pattern forming. So now to look at the combination of and confirmation of price action with an indicator. So the indicator of choice for me right now would be a moving average. All right. So to get your moving average, you click your FX, which is indicators and strategies. Okay. So when you click that, you've got the whole library of indicators, or if you want a particular one, you search for it, moving averages. I've done a full tutorial, in-depth tutorial of TradingView. I'll link it to the bio of this video. So let's just use one. All right. Let's look at confirmations on this moving average. So basically looking for a price action around the moving average. All right. So if you're bullish, you'll be looking for a bullish price action above the moving average, on the line but above the line. All right. So here's a good one. All right. It was a small trend, but this is a morning star. So remember morning star, bearish candle, doji, and then a bullish candle, usually the same size or bigger than the bearish candle. All right. So as you can see here, there was your morning star happening on the moving average, and the moving average at this point indicates the trend is up. So you have extra confirmation that this is going to be a bullish trend. All right. And lo and behold, it was a bullish trend and the trend continued. Let's look for a good one in the opposite direction. Okay, so, all right, the trend is down. Let's zoom out. Doesn't seem to be a good. All right. All right, let's look at it in this instance. Okay, so there's been a small trend. All right, there's been a bearish engulfing pattern, and although it's above the moving average, which indicates that this trend is actually up, but there's a lot of rejection on the bearish side to bring the price down, which brought the price below the moving average, which indicates that the trend is now bearish, okay, because it's below the moving average. And this has brought the price all the way down and kept it below the moving average. Although the patterns are picked are cherry picked, you need to be dynamic when trading. Okay, so if you enjoyed this video, make sure you smash that like button, comment, and of course subscribe. All right, if you're new, make sure you subscribe and hit that notification bell. If you're a new subscriber or you've subscribed before to my channel, a big, huge thank you, all right, for the support. I appreciate it, and I hope you continue to find this information valuable, and I'll keep the videos coming. Thanks, guys. I'll see you in the next video.